Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video, I would like to look at 10 different companies that are really high quality businesses. And I genuinely mean it, that some of these companies are some of the best companies in the stock market. So I want to share with you guys why I think these companies are high quality businesses. And of course, if you're interested, please always do your own research. And normally when we talk about high quality businesses, we want to invest in companies that give us a potentially high returns. That's the most important thing for us, right? And we also want to make sure that this company have like predictable cash flows. They have a growing revenues, really good margins like profit margins, return on equities, return on invested capitals, and so on. We want to make sure these companies tick all of these boxes. And I think the companies that are found today, all 10 of them have those basically metrics that could potentially help us in the long run. Now, it takes a lot of time and effort to put these videos together to share and share it with you guys, of course. And really, genuinely, it will cost you 15p per day if you join us here, where you get access to the buys and sells, all the dividend trackers and so on. Then you have a private Discord where you can actually talk to a lot of brothers who are sharing very good practices. And then you got the Sharia Compliant Investing ebook that's also available on the website if you are new to investing, inshallah. Now, let's get started. What are we looking for? We're looking for the market cap of these businesses, because they will tell us how big these companies are. The moat will tell us if these companies have basically can protect themselves against the competition. The price 5-year growth rate, so this will help us understand where the company has been in terms of revenue side of it. Is the revenue actually growing every single year? And the last 5 years, we also want to see the EPS. If the EPS is growing, we want to see profit margin. Profit margin is basically measures the profitability of these businesses, and the higher the better. So if we're looking for I say 15 and above is really good. 20 and above is really good. I mean, like 30 plus will be excellent, and so on. Return on equity and the return on invested capital will help us understand how effective the management is with the capital they have, with the money that they get from us, and for the capitals they get from us, from the investors and the banks and so on. What are they doing with that? Are they actually using that money to give us higher returns and so on? They're reinvesting into the business. Free cash flow margin will help us understand how much company how much money the company has in the basically currently in the bank that they could potentially use for paying dividends. And the free cash flow margin actually divides the free cash flow that basically the company has by the sales or the revenue side of things, and helps us, of course, understand how profitable these businesses are. And total return in the last 10 years will also tell us exactly where the company has been. It's not going to tell us what's going to happen in the future, but this will help us understand as well, because these estimates comes from these analysts who are experts in these fields and looking at these businesses week in, week out, and they understand what to expect from them. So for the next 5 years, they will tell us basically what they think, but in line with what the company has said in their earnings report and so on. And valuation, I use Morningstar a lot, because it's one of those websites where it has information, it has a lot of information, but their valuation, I feel like, has a margin of safety. They're not kind of over predicting everything. And then the fair value will tell us where the stock basically should, based on what they think where it should be, basically. Right, so the first two companies we're going to look at are very identical. So I'm going to do both of them at the same time. And that's Visa and MasterCard. Both companies deal with the transactions. They don't deal with anything to do with the river side of things. They are technology companies. They're the technology behind the cards that we use. Okay, they've nothing to do with like how much interest you pay for this company, for this card over that card. No, nothing to do with that. They are interested in making sure that transactions happen between us, the bank, and of course, like anything, the businesses that we buy products from and so on. Visa has a 560 billion market cap, and MasterCard have $428 billion, and both of them have a wide economic moat. So wide economic moat is basically what we're after, and this basically for all 10 of these companies, they all have wide economic moat, which is basically very important in this video. Now, price right now $275 for Visa, and MasterCard $456 per share. In the last 5 years, as you can see, both of them are very similar in terms of revenue growth, and both of them are kind of almost there, similar when it comes to EPS growth, about 11, 15, 13, 18, which is not bad at all. Profit margin, look at this. Okay, 53. Remember what I said about 15 is actually nice and 20 is really, really good. Look at these companies, 53 and 46. Return on equity 45% and 188%, and return on invested capital of 35% and 64%, which is absolutely huge. Now Visa has the upper hand when it comes to free cash flow here. They have almost $20 billion, and MasterCard has about $11 billion. Free cash flow margin margin of 59% and 41%. Total return in the last 10 years very similar. Next year Visa is expected to grow about 12%, MasterCard about 16%, then 13%, 19% after that every single year for the following 5 years. Both of them are fairly valued right now. $260 per share right now is $275, and then MasterCard 451, 456. So MasterCard is quite close to it is fairly valued. If it actually goes down a little bit more, it will become undervalued, whereas Visa must have come down quite a bit. Next one we're looking at is one that I own in my portfolio as well, and that is MSCI. 40 billion market cap right now. Wide economic moat, $509 per share, 11% in terms of revenue side of things for the last 5 years. EPS about 17%, profit margin 45%, return on invested capital of 35%, free cash flow $1.1 billion, free cash flow margin of 35%, which is absolutely huge. Total return the last 10 years 29%. Growth estimate for next year 14%, 13% after that for every single year. Fairly valued right now, $460 per share. I will be adding, although it says 460, I genuinely think that is still room to grow, so I'm gonna just keep adding a little bit more as much as in the next few weeks to basically have a full position, inshallah. The next one is Novo. This is one of the companies that has gone up so much this year because of the weight loss drugs with Eli Lilly and so on. It has 584 billion market cap, wide economic moat, $134 per share right now. In terms of revenue side of it, 11% growth in the last 5 years. Same goes for EPS, about 13%, profit margin 36%, return on equity 99%, return on invested capital of 82%, which is really huge. $7.3 billion of free cash flow, 21% free cash flow margin, and total return the last 10 years 21%. Growth estimate next year 22%, 3% after that every single year. 53% premium right now. Very, very expensive. $86 per share is where they think the price should be. Right now it is basically $134 per share. If you have not liked the video yet, please do it, because it genuinely helps the channel and it takes a lot of time and effort to put these videos together. Next one is Fair Isaac Corporation, 35 billion market cap. This company operates in score and software business. Currently has a wide economic moat, $1,384 per share right now. The 5-year growth rate in terms of revenue is only 8%, but the EPS is about 20%, profit margin almost 30%, and then return on equity is not displayed for some reason on this one. I'll check that again. Return on invested capital of 52%, and free cash flow right now 408. Remember, it's only about 34 billion market cap, but free cash flow right now is not great, 467 million. Free cash flow margin of 30%. Return on equity will look total return in the last 10 years will look at about 38%. Growth estimate next year 23%. After that is 25%. 40% premium right now. It should be about 1,000 according to Morningstar. Right. Next one that we're looking at is Eli Lilly. One of the things that I've noticed about Eli Lilly in the last few quarters is has basically, when it comes to free cash flow, it doesn't have a positive free cash flow. But I'm sure that's about to change based on what has been happening to the company in the last few months. So right now they have a market cap of 693 billion market cap, which is absolutely huge. I think this is probably one of the, I think this is the biggest pharma company right now, because I know J&J used to be, it was about 400 something. So yeah, wide economic right now $803 per share. In terms of price right now, the revenue side of it 7% in the last 5 years, 13% in terms of EPS, 17% profit margin, return on equity 53%, and return on invested capital of 30%. Free cash flow margin right now is not great, but I hope they can improve that, because this is a very high quality business. Has gone up so much in the last few months, so it'll be interesting to see where it's heading. There's so much demand for this business. Look at this as well. So total return in the last 10 years, we're looking at about 30%, 40% expected to grow the earnings about 40% this year, then 57%. So I'm sure this will change if the company starts to make profit of the basically these drugs that they've actually introduced recently. 43% premium, $540 per share is basically where they think the price should be. Next company we're looking at today is Applied Materials. This is one of the semiconductor companies. I've got a video coming up about this company and others in a similar sort of sectors. 183 billion market cap, wide economic moat, $218 per share. 5-year growth rate in terms of revenue, we're looking at 8%, 13% in terms of EPS. In terms of profit margin, 27%. Check this out, every single company so far we've seen is double digits. So 27% right now, return on equity 45%, return on invested capital 32%, and $7.7 billion of free cash flow margin of 26%. 28% in terms of total return in the last 10 years, 15% growth estimate for the next year, and then next 5 years exactly the same. 31% premium right now, $168 per share is where they think the price should be. Next one is one I own in my portfolio, ASML. This company is one of the most important companies out there in my opinion. All of these basically AI things we're talking about, the Nvidias and all of that, companies will not be able to make those chips without basically the equipment this company creates. So their equipment is basically what Taiwan Semiconductors use to build those basically chips, and Intel and so on. So they have one of those equipment costs over 100 million, so they are very, very expensive. 365 billion market cap. Currently they have a wide economic moat. Price is $929 per share. 5-year growth rate 15% in terms of revenue. In terms of EPS, 23% in the last 5 years. Profit margin 23%. Return on equity 60%. Return on invested capital of 44%. $2.5 billion of free cash flow. Free cash flow margin 9%, which is quite low. Total return in the last 10 years 28%. Growth estimate for the next year 56%. Then 22% after that. Fairly valued right now $890 per share is where they think the price should be. Right now is only 920. Let's call it 930. So it'll be interesting to see if it comes down, if it carries on going up. Next one is Zoetis. This is one of the animal healthcare companies, almost 80 billion market cap, wide economic moat, $173 per share. In terms of revenue side of things, the last 5 years we're looking at about 8% growth, EPS about 12%, 27% when it comes to profit margin, 50% return on equity, 26% when it comes to return on invested capital, $1.7 billion of free cash flow margin of 20%, and 20% total return in the last 10 years. Growth estimate next year about 11%, 10% after that for every single year. Fairly valued $170 per share is where they think the price should be. And finally, S&P Global. This is one of the companies that I do own in my portfolio. 138 billion market cap, wide economic moat, $440 per share right now. 15% in terms of the revenue growth the last 5 years, 9% in terms of EPS, 22% in terms of profit margin, 8% return on equity, return on invested capital about 9%, which is not great. Free cash flow right now $3.9 billion. 31% in terms of free cash flow margin, which is wonderful to see. Total return in the last 10 years 20%, and then growth estimate next year 13% every year after that. Fairly valued $430 per share. Right now it's $440, so not far off from basically what Morningstar actually thinks it should basically be trading right now. So there you have it. That's the 10 different companies that we talked about. All of them today have a wide economic moat. Profit margins are really, really good, all double digits in here, which is really nice to see. And total return the last 10 years we're looking at also double digits, which is nice. Growth expected, all of them are really good apart from Novo here. I'm not sure why it's just 3%, and in comparison to this one here, Eli Lilly, which is similar sort of well, they're not very similar, but they have similar sort of drugs these days. But yeah, so just 3%, but the rest of them are doing really well. Like we said, majority of them are actually fairly valued right now. So if we see a dip in the market, you might actually get some of these companies at discounted prices. For example, MasterCard is really very close to where basically they think should be. Now, with this, I would definitely add another 10% or 5%, depending on how you think about in terms of the the risk side of things. 5% if you think is a low risk, 15% is a very high risk, and 10% is kind of moderate. And normally I like to use 10%. Right, let's have a look at the Sharia compliant side of things. Again, according to Zoya Sharia compliant, the standards, okay, as you can see here, this is what is currently displayed on Zoya, and as you can see, that none of these companies have any issues. In fact, they have a lower interest bearing debt and lower interest bearing securities than most companies out there, which is really nice to see. So there you have it. That's the 10 companies I wanted to share with you guys today. Genuinely, I really like some of these companies. I'm doing a little bit more research on some of them. I do own these 3 here, and I also own these 2 here. So the 5 that I own, I'm going to very quickly show you, just to be honest and transparent with you guys. I own 5 shares of ASML. I'm up about 44% for that one. I also own in this portfolio MasterCard. I'm down about 3% so far. MSCI, I've owned basically about 4% down right now, about 7.3 shares of that company. I do also own S&P Global, basically about 20% up, and Visa as well, 27% up so far this year, so far since I bought it. So there you have it. That's the 5 companies, that 10 companies I wanted to share with you guys. They really genuinely, I feel like, high quality businesses, but always do your research and be mindful. You know, anything can happen, any of these things can change. So as long as you do your research, inshallah, I'm sure you will be fine. Have a wonderful day. Assalamu Alaikum.